Ever wondered how installment debt might be impacting your financial health? Let's dive into the world of finance and unravel this concept. Installment debt is a type of loan that you repay over a certain period through a set number of scheduled payments. Imagine it as a financial journey, where each payment is a step towards your destination. Complete repayment. It's like buying a pricey gadget or a dream house, but instead of paying the entire cost up front, you pay in parts, over time. This is the essence of installment debt, and it's commonly used in a variety of loans. Mortgage loans for your homes, auto loans for your vehicles, and personal loans for any other financial needs you might have. They all operate on the principle of installment debt. So, installment debt, if managed well, can be a beneficial financial tool. But what are these different types? Diving into the world of installment debt, we encounter different types, each with its unique features. First up, we have mortgage loans. These are long-term loans, typically spanning 15 to 30 years. They're used to finance the purchase of a property, with the property itself serving as collateral. Next, we meet auto loans. These are shorter-term loans, generally lasting 3 to 6 years. Auto loans finance the purchase of a vehicle, with the vehicle acting as collateral. Finally, we have personal loans. These can be used for a variety of purposes, from consolidating high-interest debt to funding home improvements. They typically last between 2 to 5 years and may require no collateral, making them unsecured loans. Each loan type is unique with its own terms and uses. But what they all have in common is that they must be repaid in regular installments over a specified period. Now that we've understood the types, it's time to unravel the concept of interest rates. Interest rates can be tricky, but they're a crucial part of any loan, including installment debt. To put it simply, interest rates are the cost of borrowing money. They are how lenders make a profit from providing loans. Now, when it comes to installment debt, interest rates significantly impact the overall cost. There are two main types of interest rates you'll encounter: fixed and variable. A fixed interest rate stays the same throughout the loan term. It provides stability, but you might miss out if rates drop. On the other hand, a variable interest rate can change based on market conditions. This means your payments could decrease or, unfortunately, increase over time. Understanding these differences is key to making informed borrowing decisions. It helps you anticipate how much you'll pay over time and whether you can afford the loan in the long run. Armed with the knowledge of interest rates, managing installment debt becomes less daunting. But how can one do it effectively? Managing installment debt effectively can be a game changer for your financial health. Let's talk about some strategies to keep your finances in check. First, budgeting is key. By allocating specific amounts to your expenses, you can ensure that you have enough to cover your installment payments. Next, making timely payments is crucial. Not only does this prevent unnecessary late fees, but it also helps you maintain a good credit score. Remember, your credit score is a reflection of your financial behavior, and late payments can negatively impact it. Avoiding common pitfalls is another important aspect of managing installment debt. One such pitfall is taking on more debt than you can handle. Before taking on new debt, evaluate your current financial situation. Can you handle the additional monthly payments? Finally, consider the impact of interest rates. High interest rates can significantly increase the cost of borrowing. It's important to understand this before committing to a loan. While managing installment debt is important, understanding its impact on your credit score is equally vital. Did you know your installment debt can affect your credit score and overall financial health? Indeed, the way you manage your installment debt, whether it be your mortgage, auto loan, or personal loan, can have a considerable impact on your credit score. Every time you make a payment on time, you're building a positive payment history, which counts for about 35% of your total credit score. However, if you're late or miss a payment, your credit score could take a hit. Moreover, having a high amount of debt compared to your income, also known as your debt-to-income ratio, can lower your score. Maintaining a good credit score is crucial when managing installment debt. It can lead to lower interest rates, saving you money over the life of your loans. It can also open up opportunities for more favorable credit terms in the future. So, the key to financial health is understanding your installment debt, managing it effectively, and keeping an eye on your credit score. Remember, knowledge is power when it comes to your finances.